Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is December 21st, 2014 edition of Market Outlook. Don't forget to go to our website and sign up for this and get it free every week, including the text version. So without further ado, fireworks in the market. Let's take a look at where we are. Lots of interesting things going on in the world as well. First of all, the spiders. As you can see, a very strong pattern here off of the 50-day moving average. We're up almost 3% for the week, sort of correcting a fairly severe down move. We did have a massive 300-point day on the downside, as well as a 300-point down day on the upside. Now, interesting, we did have an accumulation day in terms of volume on Thursday, confirming the gap up and the breakout and holding this cyan line here, which is the 10-day moving average. So the low on Thursday and the 10-day moving average sort of critical to hold. Meanwhile, we're just a hair less than a percent or so, or even less, from the all-time highs, which is just above 208. So with the ATR of $3 or $3.50 with the recent volatility, less than a day's trading range away from all-time new highs. As you can see, we have that short-term trading pattern right off of that rising 50-day moving average. We did have that accumulation day on Thursday. That's a good sign. We're not overbought yet. So price momentum, clearly everything is in gear. The United States continues to play its dominant role in virtually all asset classes, from rates to its currency to its stock market as well. Let's take a look at IWM. This was sort of the what I would call the canary in the coal mine, and it's been lagging all year. So finally, we've been hovering between up or down for the year, a couple of percent either way in the last month. So back in the end of December 2013, we closed right around 115, 116. This past week we moved down, tested this 200-day moving average. Now, interesting to note here is that for the first time in a while, the 50-day has actually turned above the 200. This is the first time it's done it since September, moving positive. The 200 is basically flat, and we're trading now positive on the year. Now, if we can get above the all-time high here around 121 or so, let's check out exactly what that price is. Yeah, it's just above 121. That would be and could ignite a pretty strong rally in IWM at the end of the year. So let's keep an eye on that. This could definitely be a leading indicator. Also of interest, you can see the technical pattern besides the 50 moving up above the 200, the slope rising, now trading above or at basically the resistance level. You sort of have this head and shoulders pattern that was traced out since the midsummer in IWM. And if we can get this thing moving, we can definitely get a pretty nice size move. The count alone is about 10% here from the neckline to the head part here of this inverse head and shoulders. So starting to get a little bit rich on the shorter term RSI, but not quite there, so plenty more room on the upside. Let's take a look at some of the market internals. First of all, you can see we hit oversold on the McClellan and now have moved back above the minus 100 level, and actually we're trading at a plus 60, which would trigger a buy signal on the SPY. That has been confirmed on advanced decline on a shorter term basis. As you can see, we have moved above the minus 2000 level, now only down from minus 1300 on the advanced decline, and we actually got oversold, tripped in as a buy signal. And as you know, we like to look at up-down volume as well as advanced decline for the shorter term to confirm an oversold condition and put us into a buy signal, and that has occurred. So all systems go on market internals as well. Taking a look at the VIX, you can see the VIX, we got this spike up. It looked as though it was possible that you might have had a more sustained move to the downside in the markets with volatility picking up, but we have to go with the market tells us and the market action. And as you can see, we got to the upper end of the Bollinger Band, moved back in, which tells you frothiness on the upside in this and the downside in the market. Definitely got overbought. We're now back into the middle of the Bollinger Bands, and as well, we're now trading under the 50-day moving average and under the 200 as well. The 50 is under the 200, back to a complacent, or not a complacent market, but rather neutral readings in volatility. So gone from excessive caution, maybe some irrational exuberance on the downside, and we reversed it this week. So again, VIX back into the midpoint of its range. It is neither a buy or a sell signal. However, it has moved under the 50-day moving average, putting it more into a positive mode for the overall market and negative for the VIX itself. Let's take a look at interest rates. Very, very interesting action. As you know, the longer term trend in rates, especially the long bonds here, the 20-year, which is the TLTs, we actually took out by just about 4 ticks on this particular day when you got this this sort of doji hammer type day and the sharp sell-off. We basically attacked the all-time highs. It was rejected, and it'll be interesting to see how this plays out. Can't really argue about the long-term trend in U.S. rates, especially these long bonds and people moving money from all regions of the world, from the Middle East, from Russia, parts of the EU, into all types of U.S. assets. Here's a perfect example. Really good action on Friday, which is interesting. The key thing to watch here to see, there is a potential for a top in here, right? We had this blow off back in October, along with the sell-off in the market. Rates dropped, the TLTs peaked. We matched it here on a minor sell-off and in U.S. equities, and a rather huge sell-off in Russia. However, the key number here to watch now is this 124 number. If we start trading under 124, there's a potential that a double top might have been put in, and you might have seen the high in prices here in interest rates. Now, another confirming thing to watch would be to see the spread between junk bonds and U.S. bonds narrow. And so what would be a confirming indicator would be a move above 39.50 in junk. Remember, with oil prices dropping, lots of money has been invested in fracking and developing oil. So there were lots of junk bonds that look like they could be under pressure. Hence, massive sell-off in junk bonds. We were trading just a couple of months ago in the low to mid 40s. Now we would drop down to 39. That's a pretty good size drop. for junk bonds, considering its overall volatility. And again, what I'd like to see that this potential bottom pattern in here against the lows back in 2012 hold, and we start trading above 39.50 in the ETF called JNK junk bonds. So that, in conjunction with potentially the TLTs topping at that and taking out 124, could be an interesting convergence. So again, if oil starts to arrest here its downside move and continue and potentially stabilize, you could see this moving back up, which in a sense might have money flow back into higher yielding stuff and actually attract money from the US bonds as well. Let's take a look at inflation, deflation. This is a chart, a ratio chart, the bottom chart here of bonds versus gold. And as this ratio continues to increase, including trading above the moving average, tells you that inflation is quite under control, and we're really more concerned overall about deflation. So again, bonds strongly outperforming gold, gold stabilizing right at its lows going back to 2013. It'll be interesting to see what happens. You sort of have this upward channel forming, potentially a wedge follow, which if this thing breaks down here, you're going to have more trouble for the yellow metal. Trend line here, that critical low around 112. If it gets taken out, again, looks like new lows in gold. In the interim, it looks like it's holding right at a critical swing point here, which is around that 115 level. Let's see what else we have. One thing I did want to go back to is a longer term chart in the spiders. And in fact, what I really want to do is go to a monthly chart. Okay, so in terms of length and of economic cycles and how it relates to the highs and lows of the overall market, take a look at the spiders from high to high. And basically, you can see somewhere in the mid part to latter part of 2000 was the peak before the dot-com bubble burst. The next high took place approximately almost to the month about 7 years later, and that was at the in September of 2007. So 7 years later should be the winter months or around late fall of 2014. So this is telling you that the overall economic cycle, that longer term liquidity cycle, should be peaking out. Now it's interesting that stock market valuations relative to the GDP are peaking as well. Now, because of the unique situation of the Fed, QE2, liquidity cycles, these things can be off by months or more. So these are longer term views. Clearly, with the GDP versus the stock market at relatively high or historic levels, or not quite historic levels yet, and the time factor running out, it will be interesting to see just how long this stock market rally persists. Remember, we still have the December effect, which is yet to fully play out, which is extremely positive for the market overall. And obviously, with the momentum we just spoke about and still working off its oversold condition, we can see certainly some more to the upside. Question is, how far can the dominance in all three asset classes last? And can the U.S. equities market pull up the rest of the world, or will it ultimately be pulled down? So again, we got some of that short-term market action which we laid out, support and resistance points, and a couple of the individual ETFs, which should help you. Other than that, that's the overall scenario. And hope to have a great holiday and wish you all the best. And probably see you next week. Thanks. Bye for now. This is Keith Schneider signing off from MarketGauge.com.